Value investing might not be as risky as criticizing your girlfriend's new cooking recipe, but there is risk that you need to be careful about to not get burned. Watch this video if you want to learn how to manage risk in your investing decisions. Today, we are looking at 7 risks that you absolutely need to be careful about if you don't want to lose money. First, figures are important. Financial statements are frequently consulted by investors before choosing a value investment. Hence, if you rely on your own analysis, ensure that your data is current and your calculations are correct. If not, you can find yourself investing poorly or missing out on a terrific opportunity. You should postpone making investment decisions until you're well prepared. If you're unsure of your capacity to read and comprehend financial figures and reports, continue your studies. One strategy is to read the footnotes. These are the notes in Form 10-K or Form 10-Q that explain a company's financial statement in greater detail. The notes follow the statement and explain the company's accounting method and elaborate on report result. The notes follow the statements and explain the company's accounting methods and elaborate on reported result. Here, you can see example of a 108-page 10-K form for Microsoft published in June of 2022. Second, extraordinary gain or losses. Certain events that may appear on a company's revenue statement have to be seen as exceptional or exceptional cases. They are known as exceptional item, gain, or extraordinary item, loss, and are typically beyond of the company's control. For example, lawsuits, corporate reorganization, or even a natural calamity. You may be able to predict the company's performance in the future if you take this factor out of your study. However, think critically about these items and use your judgment. If a company has a pattern of reporting the same extraordinary item year after year, it might not be too extraordinary. Also, if there are unexpected loss year after year, this can be a sign that the company is having financial problems. Extraordinary items are supposed to be unusual and non-recurring. Also, be aware of a pattern of write-off. Third, ignoring ratio analysis flaws. We talked about financial ratio in the last video and how to calculate them. There isn't just one way to determine financial ratios though, which can be fairly problematic. The following can affect how the ratio can be determined. Ratio can be determined using before taxes or after taxes numbers. Some ratios don't give accurate results but lead to estimations. Depending on how the term earnings are defined, a company's earnings per share, EPS, may differ. Comparing different companies by their ratio, even if the ratios are the same, may be difficult since companies have different accounting practices. So, like I said in my other video, be careful when you calculate this ratio and be even more careful about how you use them for your analysis. 4. Buying overvalued stock. Overpaying for a stock is one of the main risks for value investor. You risk losing part or all of your money if you overpay. The same goes if you buy a stock close to its fair market value. Buying a stock that's undervalued means your risk of losing money is reduced, even when the company doesn't do well. Recall that one of the fundamental principles of value investing is to build a margin of safety into all your investment. This means buying stocks at a price of around 2/3 or less of their intrinsic value. Value investors want to risk as little capital as possible in potentially overvalued assets, so they try to not overpay for investments. 5. Not diversifying. Conventional investment wisdom says that investing in individual stocks can be a high-risk strategy. Instead, we are taught to invest in multiple stocks or stocks indexes so that we have exposure to a wide variety of companies and economic sectors. However, some value investors believe that you can have a diversified portfolio even if you own only a small number of stocks, as long as you choose stocks that represent different industries and different sectors of the economy. There are other side of experts though that say differently. If you want to get a big return, try choosing just a few stocks. They say having more stocks in a portfolio would probably lead to an average return. Of course, this advice assumes that you are great at choosing winners, which may not be the case, particularly if you are a value investing novice. 6. Listening to your emotions. We also talked about this earlier. Rapidly, it is difficult to ignore your emotion when making investment decisions. Even if you can take a detached, critical standpoint when evaluating numbers, fears and excitement may creep in when it comes time to actually use part of your hard-earned saving to buy a stock. More importantly, Once you have purchased the stock, you may be tempted to sell it if the price falls. Keep in mind that the point of value investing is to resist the temptation to panic and go with the herd. So don't fall into the trap of buying when share prices rise and selling when they drop. 7. Market is not efficient. Value investing requires diligence and patience. Estimating the true intrinsic value of a stock involves some financial analysis, but it also involves a fair amount of subjectivity, meaning at times it can be more of an art than a science. Two different investors can analyze the exact same valuation data on a company and arrive at two different decisions. Some investors who look only at existing financials don't put much faith in estimating future growth. Other value investors focus primarily on a company's future growth potential and estimated cash flow. And some do both. Noted value investment guru Warren Buffett and Peter Lynch, who ran Fidelity Investment Magellan funds for several years, are both known for analyzing financial statements and looking at valuation multiples in order to identify cases where the market has mispriced stocks. Despite different approaches, the underlying logic of value investing is to buy assets for less than they're currently worth, hold them for the long term, and profit when they return to the intrinsic value or above. It often doesn't provide instant gratification. You can't expect to buy a stock for 50 on Tuesday and sell it for 100 on Thursday. Instead, you may have to wait years before your stock investment pays off, and you will occasionally lose money. The good news is, for most investors, long-term capital gains are taxed at a lower rate than short-term investment gains. Like all investment strategies, you must have the patience and diligence to stick with your investment philosophy. Some stocks you might want to buy because the fundamentals are sound, but you'll have to wait if it's overpriced. You'll want to buy the stock that is most attractively priced at that moment, and if no stocks meet your criteria, you'll have to sit and wait and let your cash sit idle until an opportunity arises. Like always, comment, like, and subscribe if you've liked the video and you want to be a better investor. Have a good one, everybody.